In this final section, we're going to look at the management of a trade, when to move a stop, when to get yourself to break even, and when to take a profit. In looking at your 14-2 chart, when you're going to place a trade, you should think about a few things. What are my synthetic triggers width and location on my 14-2 chart? Where did we come from before I'm going to do the trade? What are my trigger lines look on the 14-2 chart? And then what could be the possible first trouble spot that I would hit on my 14-2 chart? And you're going to have to repeat this process, whether it's a long trade or if the market reverses and you start doing short trades, you have to, again, think, what did I have prior? Divergence up at the top. What are the strength of my trigger lines? And most importantly, where are we going? What's going to be the first trouble spot or support area that I'm going to hit with my short trade? And it's not just what's in your way. It's what happened prior. Did we break multiple time frame resistance? Where are the small trigger lines prior to my entry? Was there divergence prior to the entry? Which side of the synthetic triggers are my small triggers on? And then ultimately, what's in the way between my entry area and my Fibonacci target area? In this following picture, you'll see very, very simple, very easy looks for a trend trade long. Small triggers above our synthetic triggers with no divergence. The market pulls back to Fibonacci support, and absolutely nothing in the way until we reach our Fibonacci target up at 64.72. Now, once we reach 64.72, you'll see we put in the potential for divergence, and the market trades back down to the downside. And again, if you were to go short at the edge of resistance, usually the mid-band is your first target. So as we reach the mid-band the first time with our synthetic trigger still up, if you were short, then that would be a really, really good spot to start watching for a profit target. And you can see we went a little bit lower and we made a little pivot stop out. Again, anytime you reach a prior pivot, high or low, especially when there's a divergence at that pivot, it's very, very significant. If you cannot continue down and the market starts to get back above that divergence line, you want to get out of any type of short trade. Many traders who are trading long trades will use that look as a long look to get back up to Fibonacci resistance. Usually the market will make one more push back up to retest a Fibonacci resistance if we're in a strong trend to the upside. This pivot stop out is usually where that spot happens. Now, as we trade back up into Fibonacci resistance, this is where our counter trend traders start looking for the opportunity for a really high probability short trade. Prior Fibonacci resistance with divergence, with a divergence line at our Fibonacci resistance area, a second divergence at the high, and this is the type of trade where, again, because we've already had the first move off of resistance, typically the second move will not only reach the mid-band, but continue a little bit lower. So the expectation the first time from resistance is that the mid-band area will hold and make the market go back up. The second time from resistance, typically the mid-band will break, and even after a little retracement, the market will continue down a little bit lower. So again, you have to go into each of your trade setups with an expectation of the target areas. Should they hold? How exactly am I going to manage my stops, what should happen next based on the read of my fibs, trigger lines, and divergence areas. So I want to go back to our 14-2 chart. Again, one spot where we're looking for a long trade, one spot we're looking for a short trade. Now we're going to start with the trend trade on the left side of the chart first. You'll notice first we have a trend change to the upside. We have no divergence on the pivot above the trend change. Because it's a larger gap back to the synthetic triggers, we're looking at the blue Fibonacci support line and the synthetic triggers for the area in which we're going to actually place the trade. Now, once we reach the area and once the trade is actually placed, so again, obviously the closer you can get into the area, the better. What I've done is I've put a 10-tick risk box, if you will, for that's in red. And again, with this 10-tick risk box, I've also drawn a corresponding 20-tick profit target window. So again, anytime you're about to take a trade, I want you to be able to visualize, and if you want to, you can even put boxes on your charts. Put the 10-tick stop in so you can see where your stop would go, where a max risk would go. Put in a 20-tick profit target box so you can see how much room you've got to your trouble spots. And then you can see in this first scenario, if you got in pretty close to the right spots, you very easily made 20 ticks before you got to the prior divergence highs. Made more than that by the time you got to the next Fibonacci resistance. So again, very easily able to pull 20 ticks out of that first long trade. Now, stop placement's going to be the same for every single trend trade. You're going to initially get into your position, and initially you're going to have 10 ticks risk. What's going to happen after you get into the trade and after this bar closes to the upside, you're going to put your stop literally 1 or 2 ticks below that pivot. So you may start out with a 10-tick risk, but after the pivot, depending on your entry area, you may end up only having 3, 4, 5, or 6 ticks worth of risk. So it really starts to add to the risk-reward ratio when your average risk will end up being 6 or 7 ticks and your average profit target will be 20 ticks. It's a really, really nice win-to-loss ratio. Now, if you remember from our trend trade section, if all 3 of your charts have negative divergence numbers on it, like we had up here, obviously you can just see the 5-1 here, but we also had it on both of our 14-2 and 5 range charts. So that's the type of look where we won't do any more trend trade longs after that, and we'll wait for a trend change and we'll start doing trend trades to the downside. So you can see as we work our way down and we actually change the trend to the downside, you'll see a repeat of what we had on the way up. We have a trend change, no divergence on the lows, and you can see this is one of the situations where we have a perfect look for a trend trade short. Obviously, the closer we can get into the perfect spot, the better. And again, one of the things that we're looking for is where is the target? So the entry area is as close to 67.73 as possible. Our target area is 63.49 to 63.43. So again, you can see with our 10-tick risk box and our 20-tick profit target box, this trade has a high expectation of making at least 20 ticks profit for us. And again, our stops are going to remain at 10 ticks until after this down bar. Once we have the down bar after our entry, Then we're able to reduce the risk and place the stop above the pivots. And again, only after the down bar are we able to reduce our risk behind the pivot. Only 25% or less of your trades are going to be perfect. The other 75% of your trades are going to have something in the way. So it's important that we read our indicators and have indicator-based rules on how we're going to manage our stops and targets. In this chart, you'll see gold 14.2 on the left. And this is one of our easier management techniques. When we have a very, very, very strong trigger line look on our 14.2 chart, with both our synthetic triggers and the small triggers very strong below. First and foremost, it's trend trade shorts or nothing. Anytime you get the really strong trigger line look, as you've learned in our trend trades and reading fibs and triggers, we want to continue to do trend trade shorts. Now, you're going to be faced with a situation where you have your first trend trade short. And when we start this trade out, you can see existing trend down, no divergence on the low pivot, and we pull back to Fibonacci resistance and our fib to fib oscillator for the first trend trade short. What you'll see next is that our small triggers are physically above our synthetic triggers. Now, once price reaches the prior low and there's divergence potential, we have to look at managing our position. For this, I'm going to take us down to our two smaller charts. So you'll see our first trend trade short area on the left on our 5-1 chart. You'll see the corresponding down bar on the 5 range chart, which would be your entry. And then once we reach the prior low, you'll see we have potential divergence on both of our charts. Along the way, on the way down to the divergence prior low, you'll notice we have a white paint bar on the way down. Generally, as we reach a prior low or a trouble spot, such as our synthetic triggers with potential divergence, we can move our stop down using the market flow behind the white paint bar, reducing our risk. The second part of that is, if you make an up bar on the 5-1 chart, you want to be out of your position. So again, at this spot right here, we'll have divergence becoming true with an up bar on our 5-1 chart. And when we have divergence on the low, typically we're going to stop out the last pivot high, and then we're going to get a second opportunity at the same short trade from a better spot. Now, very much in line with what we saw with our counter trend trades. The first counter trend trade stopped at the mid-band and went back up. Our first trend trade stopped at the synthetic triggers and went back up. Now, if we get that pivot stop out and we get that second trade opportunity, the anticipation with the stronger 14.2 chart is that the second time down to the lows, we're going to actually exceed and take out the lows and continue the trend to the downside. So not only is our profit target much larger on the second one, or profit potential much larger on the second one, the stop management is going to be a little different as well. Once you get a pivot stop out and a down bar, you're able to pull your stop above the high of the market flow pivot stop out bar. And using the same white paint bar logic, you're also able to reduce your risk once again once you get a white paint bar down, helping your short trade. Again, it's imperative that you recognize not only what the trade is that you're currently doing, but what happened prior. So as we go back and we take a look at our 14.2 chart, this spot up here was more than most likely where you were doing your short trades from the edge of Fibonacci resistance. And again, if your profit target was 20 ticks, you very easily achieved your 20 tick target. Then, just as we've discussed before, if you get a trade from the edge that ends up working, it's usually followed by a very good high probability trend trade. So again, you can see the trend trade materializing. Trend change to the downside because of the prior uptrend and the gap back to your synthetic triggers. It really starts to narrow in the area where you're actually going to start looking for your short trade. So as they close the gap back to your synthetic triggers, we're going to be looking for a short. Now, this short is a little bit different. Number one, it has plenty of room to get down to the next target. But what you'll see is a combination of two different things on two different charts that are happening at the same time. Number one, on your large chart, you have a prior pivot low. So anytime you reach a prior pivot low and you have divergence potential, you have to watch out for that prior pivot low to cause a reversal in the market. Now we have the added benefit of our small charts not only having a prior divergence low at that spot, but also having Fibonacci support at 1332. This would be an absolute target for us. So even though our large chart has the appearance that we're going to make it down to 3060, because of reaching the prior pivot low and the potential for divergence and the Fibonacci support on the small chart and the divergence potential on the small chart, we want to get out of this short position a couple of ticks ahead of or above the Fibonacci support to maximize the trade. Now, I'm going to go just a little bit further and remind you one more time about that pattern we talked about. Remember where we have multiple divergences on all of our charts at the exact same spot? That means we're going to quit doing trend trade shorts. So this would be the trend trade short that you would skip. And do you remember the pattern that we looked at before? Fibonacci support at the lows with divergence, the market making a strong move up, the market pulling back to retest Fibonacci support with even more divergence, and our fib to fib oscillator being at the 25 buy line. After divergence on all three charts, this is the spot where our counter trend traders will start looking for trend trades to the upside. So again, I know we're kind of handling quite a bit of information on this one chart, but it's counter trend trade on the large chart from the edge of resistance up here at 1336.40, which would have yielded at least 20 ticks profit. And then we move into our second trade, which is a trend trade short on our smaller chart from Fibonacci resistance and from the synthetic trigger lines after they get retested. Trading down to Fibonacci support, prior lows on the large chart. Anytime you reach divergence and prior lows, you want to exit your position. And then if you get an opportunity with this pattern on a retest, again, higher small triggers, divergences on all three charts, you can then use this Fibonacci edge as your first opportunity to go the other way. Now, let's take a look at our market flow chart at the same spot. And again, as we go back in time, this one's pretty easy to see up here at the top. This is the edge of our Fibonacci resistance and where we're looking for, potentially a short trade. And again, if you're not a counter trend trader, don't worry about it. As we work our way down, again, this is why we really like to superimpose circles on all of our charts. The trend changes to the downside. Let me get rid of that pointer. And again, this is where the market pulls back, and this is where we'll turn on our strategy that if we get any type of reversal by our short signal, we're going to go short. And again, keeping in mind, we're not going to move our stop until we have a paint bar down or a pivot down on our 5-1 chart. And you'll see we'll also have, again, a white paint bar on our market flow chart, which will allow us to reduce some of the risk further. And then you can see very clearly on this chart, we make it down to our target very easily. And again, it's not going long down here at this target. It's after this area holds and after the divergence is established and after the move goes up, this is the short trade that we're going to skip. And then if you have a market flow signal at the fib with the pattern on the 5-1 chart that we were talking about, sorry about that, let me move that over, then you'll get the first opportunity for the market to go the other way. So again, as we work our way down, you can see on the 5-1 chart, initial stop will be, well above all of this resistance. And then after the white paint bar down, which also incorporates this tail bar, we'll be able to trail our stop behind that area to reduce our risk. And then never even really needed to move it again. We made it down to our target. So again, once we make our target, then if we were going to do this long trade, right, again, our stop would be 10 ticks. After the reversal bar to the upside, then we would be able to reduce our risk and manage our position. Again, this whole process just repeats itself. So again, if you were long from here, remember, first counter trend trade long. Once we reach our mid band and or prior divergence highs, stops are break even or better. And again, first counter trend trade, you don't necessarily want to get too greedy. You can see the market did go up a little bit further, but we did bounce down from our 165 EMA. And then we basically had the same pattern again, back to the fib to fib oscillator at the 25 buy line, Fibonacci support, and even more divergence. And again, our counter trend traders would use this look for one more long trade to the upside. And again, stops are always the same. They start below the pivot, and then they move up. And then again, if we get a white paint bar and some tails and some reasons why we can move our stops up, we can move them up. And then as we trade into our target areas, obviously we're already taking profit. And then the process just repeats itself. Again, you can see trend changes, big gap back down to our synthetic triggers where they close the gap and the market reverses trend. Anytime we talk about profits, please pause the video, take a moment to read the disclaimer. It's imperative that you keep in mind the daily objectives. We want to make $400 per contract per day. So we could do 120 tick trade on crude oil, 120 tick trade on gold, and we've achieved our $400 profit. It's through consistency and trade application, which trades are you going to take under which circumstances, consistency with your pivot, stop management, managing your stops at trouble spots, and taking profit at the correct area that's going to enable you to have an opportunity to make $400 a day or better following the correct trades. So again, a couple of key takeaways that we want to talk about. Don't move your stop until you get a reversal bar on the 5-1 chart. Move your stop when you reach a trouble spot on your chart. When you're doing the first trade against the trend, always watch out for your mid-band and smaller profit targets first. If the market retests the area where you do a counter trend trade or a trend trade from, you'll have the opportunity to make more money on the second trade. Also, anytime you reach a prior major pivot in the market, watch for exits. The market has a tendency to stop out those pivots and then reverse and go the other way. Again, we thank you for your time. We look forward to seeing everybody in our live class and look forward to teaching you how to make all of your goals and objectives day trading Fibonacci. So now we're going to go over actual trend trades. So you've learned the rules and you've understood the rules, and we're going to go through and talk about things. So we're going to talk about large charts, moves on your 5-1 chart, areas that you're supposed to be trading from, and when to turn on your strategy. So you'll see, I put this little green arrow on here. You have to go into a potential trade with what's happening now in your chart. So on your large chart, very strong small triggers down. Your synthetic triggers are also crossed down. So when you look at, a couple of things breaking through fibs, and you look at a really, really, really strong down move like this one here on our 5-1 chart, 9 times out of 10, first pull back to the mid band, you're going to get a trend trade short. So you can see what we've done. We've obviously made it to the mid band, and we have enabled our strategy, and we have turned on the short and sell next reversal bar. Then again, we're looking for any reason to go short, which would be a reversal bar on our 5 range chart. So when we're waiting for trades, and again, I'm going to work through this educational content. We're going to talk about all the little bits and pieces. So
order pending.
First things first, we need a signal. When you get a signal, the strategy is going to put in stops and targets for you. So initially, what we need to do is adjust our targets. Because right away in a trade, most of the time anyway, we're not going to have to worry about the stops. So you can see, moving your targets to where you think the market's going to go initially is your first step. So whenever we do stop movement at the top, we're waiting for this down bar on our 5-1 chart. So after the down bar on our 5-1 chart, we can pull our stop down behind the high. Now we're going to use our market flow to generate some additional risk reduction. So anytime you make it to a green line, high volume line with your small triggers up, we're going to reduce the risk. And whenever we get a white paint bar down, usually not more than a tick or two above a white paint bar, we can actually get our stops down. So what that will do is it will allow us to reduce our risk pretty quickly. Now, as we look at this trade, you'll see we've traded into our synthetic triggers. Anytime you trade into your synthetic triggers and you reach your first target, you want to make sure that you're pulling your stops down. You want to make sure your stops are no more than a reversal bar up on a 5-1 chart. So you can see in this scenario, we've obviously pulled our stop down quite a bit. And again, now it's just whatever happens with the trade. We either, get out of the trade, or we're going to, hit our targets. So you can see we got out of our trade with divergence, and now we're on our next trade. We're working our way up towards the last area of resistance. And again, once we reach the area where we want to do our trade from, we turn on the strategy, we turn on the short now. And you can see from our large chart, we're at a perfect spot. So we've overrun by just a little bit here on our 5 charts, right at the reversal bar marker. But because of the overwhelming down move and the overwhelming help that we're getting from our large chart, and the fact that we've got a large gap back to our synthetic triggers, we're going to take another short. And again, you'll see we got an antenna reversal bar marker. First things first, move your targets. Just move your targets first. Don't worry about your stop. Because again, we're not going to move our stop until we get a reversal bar on our 5-1 chart. So again, trigger lines, obviously if we get a pullback to our synthetic trigger lines, and if we make it down to prior lows, and again, you can put your stop farther away if you really want to. So just kind of depends on, where your fib areas are. We're going to manage the trades constantly as we get into them. So we're in a trade from the edges with absolutely perfect look on our large chart for going down, no divergences, so we should get one push to the downside. So you can see we've got a down bar on our 5-1 chart, so we can pull our stop down. And you'll notice immediately what? That we've also run into our green midband on our 5-1 chart. And we have a white paint bar down. So what does that mean? What that means to us is that we want to further reduce our risk. So we want to use the white paint bar on the market flow. We want to use the reversal bar markers on our large chart. So we're doing two things. Number one, we're adjusting our stop. So in essence, we've only got 2 or 3 ticks worth of risk here. Number two, we're making some adjustments to our targets because our triggers are up. We've got blue fibs, we've got green backgrounds. And again, you can see on our market flow chart, we've got a reversal bar on our 5-1 chart. We've got a magenta line here. So again, we want to, keep our stop just above that. And then only when we start getting close to our next targets do we really reduce risk and get to break even plus. Once we reach our targets, like getting back to the synthetic triggers, again, maximum stop, reversal bar on the 5-1 chart. We're guaranteed to be locked in some money. If the market continues down and makes it to our Fibonacci target, then obviously you can see we end up making that. So again, just, it's the same thing over and over. Now, in this situation, look at our large chart. This is not the most favorable look for a long trade. We've got resistance up here. We've got synthetic triggers going down. We've got really a downtrend. And what you'll see a lot of times is, even in a downtrend, when you retest your triggers and you get just a little 1-tick stop out right here. If we just get a 1-tick stop out, you can have a trend trade that goes long with really only 5 or 6 ticks worth of risk to get back up to the midband and back up to the Fibonacci resistance area on our large chart. So again, this is one of those trades that if you're doing high probability trades, you don't really want to do them. This is not the highest probability trade. Now, divergence, pivot, stop out with trend trade rules being met, still not a bad opportunity for your first counter trend trade. So what you're going to do in your first counter trend trade is you're not going to shoot for the fences. You're going to have smaller profit targets, and you're going to, if you look at the low down here, this little pivot stop out low should not be broken. So if that's the case, and that low shouldn't be broken, then we can have our stop below that low. So in essence, 6, 7, 8 tick risk maximum. And again, as this trade progresses, you can see what's above us here. We've got a high volume area and our reversal bar marker right here. So, once we reach this white paint bar, reversal bar marker, potential trouble spots, go to break even. And really it's, really even break even plus a tick here because why? We've got the white paint bar up, protecting us. And it just allows us to really, use the market flow to help us reduce the risk. And again, look where we're at. We got back to the midband. This is where not getting greedy on a counter trend trade is a good idea. Could it keep going? Yes. Will it keep going? We don't know. So again, 1-tick pivot stop out trend trades to get back, that's fine. Now, once we hit major areas, we're skipping this trend trade right here. You can see, it's a really good trend trade look on the 5-1 chart, but it's, we've already hit a lot of trouble spots on our little chart. And again, these are the ones that, and I put this in here for a reason. If you skip it and it does this, you can't get mad about it. So what will happen is you'll end up with a better trade that'll be a little more high probability. So as we progress forward, take a look. We've got the last spot down here on our chart, right? And again, this is where the market flow will trick you. And I want to show you something right here that we did in class live, and I want to show you what we did. We were looking at this fib and this midband. And down here is really the last area on our chart. Down here at 55, maybe even down to 50. So really, we should hit 55 before we turn on the system. And if you don't wait for the last area to get hit before you turn on the system, and again, we did this trade live in class, so I wanted to show you what happens. And again, sometimes you have to make the decision that you're going to do the trade anyway. It's gotten close enough and it's worth doing, and if you end up losing it and you get to the best spot, you're going to end up doing the trade again. So you can see, I mean, it's pretty easy to see that at our fib and our midband that, you know, again, let me move my targets here real quick. Again, the bottom of synthetic triggers, prior divergence highs, you know, those are the spots where you want to, you know, put your targets first. Then we'll worry about our stops if we get an up bar.
Order filled.
What you can see happening is what? Now we've made it down to the best spot possible where we should have been waiting to reach before we actually put our trade on. So when you're confronted with a situation where you did something wrong, you have to really, really be confident to be able to turn on your system and say, because of my large chart area and the trigger line look and the multiple time frame fibs, and even though I did it wrong and got bumped out on the low tick, which we literally did this trade live in class.
Order pending.
I'm going to do another trade again and make myself go long if I've got, you know, a good bar structure to go long again. And what you'll see is, again, after you get your pivot up, you can reduce your risk below the low. Once you start getting white paint bars up, you can continue to reduce your risk. Once you get back to high volume areas with the trigger lines going down, you know, ideally, you know, if it gets through there, you're going to keep going, and if not, you don't want to lose too much. And you can see as this trade progresses up, now we've made it back to the bottom of our synthetic triggers. That's a good target area. So again, we made a mistake and got in a little too early. We did a good job of getting in the second time, and now we've reached a profit target. Anytime you reach a profit target, you need to think about getting your protective stop up to a reversal bar on the 5-1 chart as a minimum. And if you're approaching prior divergence highs and you're really not able to get through the synthetic triggers, then you really need to get your stops up tight. Because what will happen, you know, a lot of times at prior highs, you'll get a bar that looks like this, where, you know, again, very quickly they'll start selling off. So you see this market flow bar to the downside. It's just not worth staying in for a long time, because usually when you get that type of a look, you're going to go all the way back down and you'll get another trade. So again, we're going to work on entries and management. Super, 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 super strong move up. 100 bars straight up. You have to turn on your automated system when your triggers are that strong on your big chart and there's that big of a move first time to your midband. And again, this is the only exception to not waiting for the last area. 100 bars straight up. Super strong small triggers way above your synthetic triggers. Especially, you're going to see a lot of times multiple dots down into the area that you're looking to buy.
Order pending.
Usually you get a yellow paint bar after that, which you can see we did. And again, first things first, move your targets. Don't worry about your stop. Your stop's in place, 10 ticks max. Put your targets in the right spot where they're supposed to be. Prior highs, next fibs. Now, what we're going to do is we're going to start watching for a bar up on our 5-1 chart. Same thing. Don't go too early, but we're going to, we're going to get ready, and essentially the minute we start making an up bar, we'll be able to put our stop. So you can click on your stop, and as you start to really get within, kind of cheating just a little bit here, within one tick of it. So you can see we've got a pivot in place now. So again, we've reduced our risk considerably from our 10 tick risk. So again, waiting for the pivot up. And again, we're going to do the same thing that we did every single time. As we start to reach the bottom of our synthetic triggers, and we start to have this white paint bar to the upside, we want to pull our stop up, again, so we don't have too much risk. And again, if you get that same type of bar to the downside, you can always take one of your targets and just pull them down
filled.
And just take the money. So if you get this type of a bar, you can take your money. If you still have a very strong market up, you can always leave your second stop break even plus a tick. And then that way you can, give the market a chance to kind of get up to the prior high and maybe break through and maybe get to resistance, because there's not really another spot to get in here. So again, anytime we reach a prior high and we exceed that prior high, you really want to start getting your stop up tight. And you can see if we get an antenna bar to prior divergence high, that's an exit. I should be out right now with all of my money. Since my stop is so close, I'll just leave it there for now, but you'll see what's going to happen. Almost every time you get a market flow signal at a prior divergence high, we're going back down again. It just recognize this look, learn this look, know this look. Same thing every single time. And this is what happens. You can see we're making it down to, again, the last spot. So, again, prior divergence highs get us down to the last spot. And I want you to recognize something that we haven't talked about. Again, we talk about it in the trend trade video. We have divergence on the top of all three of our charts here. So again, the area is really good, and if we get a signal here, we're going to take it because we've had a pivot stop out, and it's the last spot, and it's a really good area. However, if we start pushing a little lower because of the divergence on all three of our charts, and we get past the 14.2 reversal bar marker, we're not going to take a trade. So look, right here, turn it off. Look at the triggers on our 14.2 chart. They've crossed over. The background colors turn red. So before we ever get an up bar, we're turning off the strategy, because even though it might bounce, now that we've had 3 divergences at the top, almost every single time those trend trades don't work. Every once in a while you get one that works, but we want to do high probability trend trades. And the highest probability trend trades for us are when all of the trigger lines are headed in the same direction. So really, if you missed it or you were going long, obviously this reversal bar would have gotten you long right here. You have to recognize now what you're trading up into. You're trading up into resistance with more divergence potential and, really our pattern for going short, fib to fib oscillator at the 75 buy line. So, some of our more astute, counter trend type traders will use this as the first opportunity to take a short trade, from right here and look to take it back down to the downside. And again, anytime you go first short trade, and I won't do the trade here, but if you were to do the trade, obviously this is the spot you'd be looking at. And if you were to do the trade, you'd be thinking to yourself, well, we're going to get down to the mid band on the big chart. And again, we'll just sit here and kind of watch it for you for a minute, but you can see we make it to the 165 EMA, which is a legitimate first target. You can see the white paint bar that we have to the downside, which on your market flow chart would cause you to reduce risk, at least to the reversal bar marker on the 5-1 chart. And then ultimately, if all things work out well, the market's really just going to finish the move off down to the midband like this. So again, while we didn't take that trade, this is more of a, what long trade usually fails. And, if you recognize triple divergence and a long trade that fails, usually that turns into your first short trend trade. So again, just recognizing triple divergence at the top. Obviously, the first short trade, we didn't take it. And you can see how pretty clearly we're starting to set up for a potential short trade, but it's after hitting the midband on your large chart. So again, we'll have to see how that plays out. One more exception for you. One of the exceptions that we talk about in the trading plan is if there's both strong triggers going down really strong on your big chart, and you break through support and you get to the edge of multiple time frame resistance, which you can see right here. So at 62.74, we've got a couple of things going on. We've got a white paint bar up into it. So again, we're talking about strong triggers down and the edge of Fibonacci resistance. All of our trigger lines on our market flow chart are down. So whenever we have a white paint bar up into the edge of resistance, we're looking for shorts. Now, our more assertive traders are going to go short at about 73. They're going to just sell the Fibonacci area and anticipate the reversal bar to the downside. Again, when you're a little bit newer, you're not going to feel 100% comfortable just getting in at a spot sometimes. So we're going to do it the other way. We're just going to leave the button on. And again, if we don't get through
Order
74,
pending.
we're going to take a short trade. So you can see we've had a reversal bar here. And again, first thing, what do you do when you get a trade? Don't worry about your stop. Put your targets in the right spot. Okay, we're going to have time to manage your trade. So first things first, move your targets to the right spot, because if the market starts to drop, it doesn't really matter where your stop is, right? And if the market putters around a little bit during your entry, it's not going to change anything, because we're not moving our stop until we get a down bar on our 5-1 chart, period. Or, a white paint bar to the downside on our market flow chart. That'll help us out as well. So again, you can see, same thing. We finally got a down bar on a 5-1 chart, so we need to move our stop down. Pretty simple, right?
Order
Reduction
filled.
of risk. White paint bar down
Order
on our
filled.
5-1 chart. Further reduction of risk, and doesn't even really matter. We made it down to our target area. So again, this is why sometimes the market moves quick. It's important to put your targets in the right spot first. So that way you've got your targets in place and you know where you're going. And again, look at your large chart. Probably going to make it down to the 165 EMA. That's our next area. And again, I'll put this in here for one reason and one reason only. If you ask to get to the multiple time frame support and get it, don't be mad if it goes further. You're going to get another trade. So let's take a look at what happens. The market bounces back up since we didn't worry about it, and we got to the last spot. Same thing over and over and over again. We got an easy trend trade short that made it down to fibs. We broke fibs. We got to the last spot. So we turn on the strategy. And again, look at your large chart here. Strategy's on. Your 14-2 chart has an excellent area to help us out from. We're right at a 1-to-1 and the 14-2 reversal bar marker, and we've got a big gap back to our synthetic triggers. So again, we're going to do one more short trade. So again, you can see the prior short we did, and now we're looking for what? Down bar from the edge with the big gap back. Large chart agrees, big gap agrees, last spot agrees, so
Order pending.
there's our down bar. And again, think about where you're going, right? Take your targets and just move them to first support lines you see and second support lines. Just make it easy. We can always adjust them as time progresses, okay? So first blue fib, prior divergence low, good enough for now, okay? Now, relax. If you were to move your stop below the high of that bar, look what just happened. You would have just been bumped out. So that's why it's imperative that you don't move your stop right away, because sometimes they're just mean and they go another tick. And then if now they start to drop after stopping out the highs and we start to get back towards, down bars, you can see what happened. We changed the trend. So again, this is using the high volume area on our market flow and our white paint bar on our market flow. And I'm going to give you one more little secret. If you're at a spot that might cause a bounce up, notice our fib to fib oscillator is at 25 and a potential sharp point, and we're at a green high volume area. If we make an up bar on the market flow chart, we're going to get a signal long. So instead of putting it above the white paint bar, we actually put this one because, potentially we go back up. I'm not sure, but you can see that reversal on a market flow chart is going to give us an up bar with the small triggers just screaming up. So again, we can kind of use the reversal bar marker right here, the high of that, plus a tick. So now we're break even. So very quickly, very easily got to break even on our trade. If it goes, great. Now, let's look at our 5-1 chart and look at our other chart and, start to figure out where do we want to really go to. Do we want to get out at 55, or maybe do we want to move it down just a little bit to, closer to where the synthetic triggers are? Again, you can see, big gap back to the synthetic triggers. Usually they like to close that gap. So, again, what we would anticipate is that we're going to go down to about 52 to 50.
Order filled.
Probably end up with a trend trade long, which we're not going to take because of the look on the large chart. So again, if you find yourself short and you find yourself heading into what looks like a potential trend trade long, don't worry about it. Just take the money. Take the money, take the money, take the money. If it breaks through, we'll get another trend trade short. If it doesn't break through, and you'll start to see, there's a market flow antenna bar to the upside, and now you're very, very happy you got out and took your money at the support. All right, guys. So again, I want you guys to really, really understand the highest probability trade that we could ever do is when the large chart is really, really agreeing with what we're saying, and both the large chart synthetic triggers are going down with the 14-2 small triggers. So when both of those triggers are really, really, really favorable and we don't have divergence on the big chart, and you can see we've gotten up to the 14-2 reversal bar marker. This is like the best of the best. I mean, this is where in class a lot of our clients just sold 62.54 just because it's such a good look and they just know it's going down. We're going to do, again, let me adjust this here. We're going to do this a little differently. Again, as a new user, you're not going to feel comfortable enough with your read of the fibs and triggers right away to just jump in at 54, right, or 55, or somewhere right in this area right here. And you can see how much time it's given us. It's given us all day and a week to get in. But you'll notice at the top of both of our 5 charts, 5 range and 5-1, we've got really high divergence number 999. That's as big as they get. So not only do we have the most perfect look that you can possibly get on our big chart, which is both of our triggers trending down really hard, we've got the last area right to the 14.2 reversal bar marker, and we have divergence potential on both of our small charts. It just doesn't get any better than this. And this is, again, one of those situations where we're expecting to get down to the 14.2 support. And we did
Order
this trade
pending.
in class, and we talked about this, You don't need anything else except super high probability trend trades. And again, this, knowing where the spot was, you could have got 3 ticks better. Allowing the automated strategy to get you in after a reversal bar eliminates the question of when and where do I get in. So again, you've got to recognize the trade setup. You've got to recognize, where are we going? So again, first things first, just quick adjustment on the chart here. Where are we going? Well, prior lows, closing the big gap back to the synthetic triggers, and Fibonacci support. So again, as we, get into a trade, again, you never know for sure if it's going to win. So this is why, and you can see it's pushing up again, could keep going. So again, we're trading with confirmation from the edges. And again, you just have to hands off on that protective stop until you get the down bar on your big chart, or your 5-1 chart, excuse me. And again, sometimes it happens really, really quickly, and you're like, okay, cool, I got a down bar really quick. And then sometimes it takes a little while. Sometimes they tinker around up at the top a little bit. And, again, you can't get worried. We've committed ourselves to $100 risk. We've absolutely, beyond question, have the last spot. We absolutely have the best look you can possibly have on the 14.2 chart. So we're going to win or we're going to lose, period. I guess that's every trade, but, we don't want to do anything to jeopardize winning, like moving our stops down too quick. So again, look, I'll put target number 1 at the synthetic trigger. So if we go back and close that gap back to the synthetic triggers, we'll have a really nice win. What is that, 17, 18 ticks? So close to 20 ticks. And look, now we've got a down bar on the 5-1 chart. We move our stop down. This is one of those situations. I want you to watch that white paint bar on your market flow chart. This is such a perfect look on the large chart. And we have so far to go down before we hit any type of trouble. I don't even want to give them a reason to come get my money, So even though we've got a white paint bar down, and if you moved your stop above it, you'd have a tick or 2 risk. We've only got 6 ticks risk anyway. So we're only risking $60 now. Again, now that we've made a push, right? So we've gone down, and our fib to fib oscillator on the 5-1 chart has gotten to, the 25 buy line. Now moving your stop down behind the reversal bar marker makes a little more sense. So we've given it a little bit of a room. We've given it, in essence, we now have $20 risk to make $300. Obviously some of it off along the way at 170. So anytime you can get your stop down behind the reversal bar marker, and look at your market flow chart. We've got a white paint bar. We've got our triggers coming down. We've got a high volume magenta line, which we're testing right here. A lot of people will add on to their position when their trigger lines roll down and they pull back to a high volume area with the triggers down on the 5-1 chart, working to maximize, really what's the highest probability trade that we have. Both triggers down on the big chart from the absolute edges in the last spot. market flow agreeing 100% that we're going to the downside. Just have to really just kind of be patient. And again, look, allow it to give a little retracement and kind of retest that market flow area. And then, don't get too jumpy. Wait until the market makes a new low. This is a perfect setup with a ton of room below us. We don't want to take ourselves out of a perfect trade. And again, I'm going to say it one more time. The highest probability trend trade that we can possibly do is both triggers pushing really hard on the 14-2 chart. And whether it's, the first area or the last area, it doesn't really matter. The fact remains, when both triggers are pushing really hard on the 14-2 chart, we have a high probability of at least testing the lows. And really even, just as much of a probability of making it down to 62.18. So again, understanding the situation. Now you can see we've started pushing down a little bit lower. We're getting closer to our first profit target. Now it's really, a legitimate idea to not have any risk in the position at all. Obviously, it went right from the perfect spot. Let me just blow this up here for you so you can see. We've made it down to our first target. Right? So anytime you make it to your first target, we have to do some assessment. What's the assessment of our triggers? Are we going to get through here? What's the triggers doing on our 14-2 chart? Everything's still really far to the downside. So we've got pretty much all systems go to hang on for at least the last lows. And again, as we start to stop out trigger lines, sorry about that, you can get your stop down to maybe a max stop of a reversal bar marker in your 5-1 chart if you want to, again, reduce a little more risk. And then as we start to push towards the lows, right, and we actually get to prior lows, it'll give us the opportunity to, again, just kind of use the market flow and big down bars and the reversal bar markers. And, again, just you want to give it a little bit of room so that way, you can stay in that trade if possible. And again, I just wanted to move it around so you can see if you pull it down too tight, they're going to bump you. So again, I moved it out of the way so it didn't get bumped. But again, there are situations where your large chart is so favorable and your triggers are so strong down that you really want to wait for, pivots, and you want to wait for little retracements to happen. And again, look at your triggers. Triggers are down, small triggers are below the synthetics. If we would have got bumped out right there, man, there'd be no way to get back in again. So again, it's important to read where your triggers are. Now that we've reached prior lows again, anytime you get back to a prior divergence low, you don't want to give up too much money. You really want it to break through and keep going to the downside like this. And then if we do, again, we get rewarded for a full-on winner when everything from our large chart is perfect. So when we get that, we really want to take advantage of those. All right, so I wanted you to take a look at what happens down here at the bottom. Number one, when we hit multiple time frame fibs and it holds, then we're not going to go short anymore. And this is actually really a perfect look. I'll turn it off because we're not doing counter trend trades here, but a one tick pivot stop out at Fibonacci support with multiple divergences. This is our counter trend trade long. And again, I'm not going to do the long trade. Just, again, I want you to recognize the long trade, because the long trade itself, even if you don't take it, means you shouldn't be doing any more short trades. So again, it's very important not only to know when you have ultra high probability short trades, but you also have to know when to stop. And anytime you reach multiple time frame fibs and the trigger lines, don't break through, and especially if you get a double divergence on your 5-1 chart and 5 range chart, pivot stop out, it's such a great spot to go long or take an attempt at a long. You've only got about 6 ticks worth of risk to make $200 to the long side. More importantly than anything else, for you, just know that we put a bottom in. And, what I wanted to really point out to you is look at your fib to fib oscillator here. So we're talking about a trend trade long. And you can see we've already made a sharp point on the 5-1 chart. Anytime you make a sharp point on the 5-1 chart and you've come off of a major Fibonacci low, even though we haven't quite closed the gap back to the synthetic triggers yet, it may be the first spot for a trend trade long. And we might go a little bit lower, but, again, a couple of ticks. So what we want to do when we have a sharp point is we want to make sure that, again, we're thinking about trend trade longs. And, again, look, somewhere in this area, and again, we're getting kind of a second chance at it, so I'll turn it on now. And again, just to jump farther ahead, you can see very quickly, very easily, it took off, reaching Fibonacci resistance up here at the top. And again, this is a trade that's made possible by coming off of multiple time frame fibs, and again, we're hitting resistances.
Order filled.
My target's quick enough, so I'll get us out of it, and you can see again, just a very easy trend trade long from the mid band with a sharp point in place, and very easily up to multiple time frame Fibonacci resistance. Okay, again, so important for us to have situational awareness. So first things first, look at your large chart. We have a double bottom with divergence telling us that we have a really good chance of making a bottom, which we did. Now we've got, again, small triggers kind of coming down. And again, we're really kind of looking for a farther away area because of the big gap on our 14-2 chart. Again, I know it's very tempting to try to take a mid-band long, but because we're coming off of this 165 EMA, and it just means that we usually go a little lower. If you bought the mid-band, you had to manage out of your trade pretty quickly once it went up and hit the yellow 1-to-1s, and the triggers never even came close. So again, we're looking for a long, and we're, because support on our big chart held, divergence on our big chart held, and, our synthetic triggers are really, really wide to the upside. And what you'll find is that these little yellow 1-to-1s will sometimes stop the market. And, again, ideally, we'd like to make it down to the fib at the round number 62, which would also close the gap and everything else. The other thing that you'll notice is on the 5 range chart, we had divergence. So this bar right here technically is the divergence pivot stop out. So if this bar goes up from here, technically we'll close back above the divergence low, and we'll end up with our trend trade long without making it to the bottom. So again, you get put into different situations when you're looking at the market, and you're like, I want to wait for the last area, but I'm within 4 ticks of it, and I've got a divergence pivot low, and I'm at the 1-to-1, and the market just isn't quite getting down to my spot, and they're just not going. So I have to really make a decision. Do I want to go ahead and turn it on? Because if this bar itself goes back up, technically I've got my divergence pivot stop out. If it keeps going down, then that's fine. It'll get to the better spot. So, every once in a while you get thrown into one of these situations where it's like, all right, do I do it? Do I don't do it? And again, you have to kind of think situational awareness. We put a bottom in on the big chart, period. My small triggers are going up really strong on the big chart, which you can see are represented on the 5-1 chart. And now it's like, oh, man, I've got a few ticks away. It's like, let me turn it on. And again, make sure you enable your strategy up here at the top. Because turning it on and not having the strategy enabled is not going to generate a trade for you. So again, I was kind of waiting and getting ready, but again, you really get into these. Let me turn that thing on. So just in case it goes up here, I would like for it to go down to the support because that would close the gap on the big triggers, but because of the 1-to-1, because of the prior divergence, because of the pivot stop out, because of the width of the synthetic
Order
triggers
pending.
going up, if I have to do the trade twice, I'll do the trade twice.
Order pending.
So you can see we've got ourselves into a position with a pivot stop out. Now the nice thing about a divergence pivot stop out is we can usually put the stop right below the low pivot on the 5-1 chart. So in essence, we have 6 ticks worth of risk. And, again, it's the overwhelming strength of the synthetic triggers going up. It was the prior divergence. It's the 1-to-1s on the range bar chart. And you can see, we'll take any reason to start reducing risk pretty quickly. So, again, we got the pivot stop out, which was good. To have a white paint bar going up is really good. So again, maybe even reducing our risk a little bit more. So, now we've got what? 3 ticks worth of risk. And as we push up a little further, and really start pushing up, it's done exactly what we wanted it to do. So 1 tick worth of risk to put a stop below the white paint bar on our market flow chart. And again, as we push up towards prior pivot highs, in essence, we can get to break even really quickly.
Order filled.
And, again, look at our big chart. We have to respect the fact that we're at some areas on our big chart and there's a big gap. So again, while we'd love to hold for, $1,000 a contract going up, we also have to think that if we get a reversal bar to the downside, then we're not really going to want to stay in this trade much longer. And again, it's a situational thing because of the big gap to the big triggers on our large chart. We didn't quite close that gap. And, sometimes what they'll do is they'll go up, stop out the prior pivot high and get a little bit deeper. And then all of a sudden they'll come back and close that gap again. So again, look where I'm putting my stop. Right below the reversal bar marker on the 5-range chart. So in essence, we've locked in a bunch of money. And if it goes down, they may go close that gap. Maybe we get back to 62 and we get a second shot at it. Maybe they keep going. So it does, again, we're at a spot that could go either way. So, again, when you get into a situation like that, you can take your money. Just take it off, hit close. And if you hit the close button, it'll take the money. If you were waiting for that down bar, that was your down bar right there on the market flow chart. So again, you have to have situational awareness. Yes, we took a stab at the trade to the long side. And yes, we got away with it. We managed the trade pretty tightly using the white paint bars. We recognized the big gap. And again, I'm just kind of moving forward a little bit. You can see it went up a little bit higher. And again, look, if they keep going up, now what do we have? We have the exact same thing that we love to see more than anything else. Small triggers going up really strong on our big chart. Our synthetic triggers are now up on our big chart. We're coming back to retest a prior divergence low and mid bands on both of our charts for a trend trade long. Again, we've got some divergence at the top. But because of, the one thing that trumps just about everything else is the overwhelming strength of the triggers going to the upside on the 14-2 chart. The lack of divergence on the 14-2 chart. And again, I put this one in here so you can see, look, we chose to get out of the last one and it went a little bit higher, which is nice. They usually come back and give you another chance. So, if we wanted to, we could be long right now. Basically, mid-bands on both charts with very, very, very strong pushes to the upside. And again, I didn't take this long trade off of both of the mid-bands on purpose because I just, again, if it's not quite perfect and it's not quite what you want, don't worry about it. If you wanted a pivot stop out to happen down here and it didn't quite happen, that's okay. And again, we're probably going to make it up to Fibonacci resistance up here. We can see where we're going, and we know where we're going, and we know we're going to 50, 54. Again, if you're waiting for lower spots, divergence, pivot, stop outs, 1-to-1s, 165 EMAs, if you choose to go a little earlier with that, reversal bar on the mid-band, obviously you're being rewarded. And again, I think the situational awareness for seeing all of your trigger lines going up on your big chart warrants a trade there. Again, I didn't take it because we didn't quite get down low enough, but I wanted to, again, talk about the situation. And again, recognizing the situation of both of your charts really, really being advantageous. And then obviously that would have been profit target for you. And you can see, look what happened after, once they've reached some Fibonacci resistance, and then look how quickly they come back down. And again, now they've changed trend to the downside. So again, very quickly, that long trade would have been rewarded, but now we've changed trend to the downside. And again, we've got trend to the downside, right? Again, situational awareness. What's happening on our large chart? Do you recognize it? We have a trend trade long on our large chart. Really, almost a perfect trend trade long on our large chart. No divergence prior. We didn't hit 52.54. So we get put into a situation where we're thinking, okay, if it pulls back to our mid-bands and triggers, do we want to take an attempt at a short trade? Do we want to take a short trade after we hit, and close the gap back to our synthetic triggers? What is it going to take for us to do that trade? And again, sometimes they come back and then sometimes they don't. Obviously, that area moves down a little bit. So again, depending on where did you come from. So, when you look back at prior divergence highs and you look at where did we come from, and you look at the overwhelming strength to the downside, right? And then you start to take into account, what's happening on our other chart. Do we have, sufficient reason to think that we're going to get another little continuation to the downside? And if so, where's it going to happen from? Right? Is it going to happen from the mid-band? Are we going to take one shot at a trend trade? And again, sometimes we don't even get a shot. Sometimes they just keep going. But again, situational awareness. Where did we come from? Right? We came off of resistance. We didn't hit the mother lode up there at the top, but we hit resistance and we had double divergences. And we have a really, really, really strong trigger to the downside. So we're going to have to evaluate. If there's no divergence on our little charts and we pull back up into a trend trade short spot, do we take one attempt at a short trade and manage it a little bit tighter? Because why? Because we're bouncing off of the top of our synthetic triggers. So again, do you see the trouble on our 14-2 chart. And again, I want you to recognize when you end up with a lower probability trend trade. And again, I'm going to do something that, again, is not as advised because, obviously when you hit a trend trade long on your big chart, being long from 05 is a better scenario. Again, we're not talking counter trend trades here. So we're talking trend trades. Right? And this is the ultimate perfect look on your 5-1 chart for a trend trade short.
Order
so I'm going to
pending.
show you what happens. So there's your reversal bar marker. And again, the idea is what? We're going to get to fibs, right? So, down here at our Fibonacci support, we'll see what happens. And again, I want to talk about the management of the trade based on what's happening on our charts. So look at my large chart. If it keeps going up, this is going to be a trend trade long, right? So again, think about your stop placement. Do you want to really risk 10 ticks when you're trading into a trend trade long on your big chart? Right? So I'll leave it at 10 ticks just to show you. Again, look, we've got a great look. We've got mid bands on both charts. We had no prior divergence. The only thing that's ruining our trade setup is this darn trend trade long look on our big chart. And again, I want to show you what happens when you don't trade with a favorable look on the big chart. Again, if you want to do the trade, it's not that you can't do the trade. You want to think about managing the trade a little tighter, right? So again, I'm going to do the trade, and again, you just have to recognize, you see we got our down bar on the 5-1 chart. My small triggers aren't rolling down on the 5-1 chart. I've got antenna bars long on my market flow chart. I'm coming off of a trend trade long look on the big chart. So again, we have two charts that are opposed to each other, and again, there's more market flow bisignal bars. So you can see the market flow is just warning us: antenna bar, antenna bar, antenna bar, white paint bar, warning,
Order
warning,
filled.
warning, and eventually you take a loser. So now you're saying to yourself, man, did I do that right? Did I do it wrong? If you're going to do a trade against the larger chart, use a larger chart area. So for example, you can see we've got that 165 EMA up there, and we've got a pivot stop out now of our short. And again, do you see how difficult that was? Once we had 2 bars down on the 5-1 chart, and our market flow was saying, hey, get out, hey, get out, hey, get out, hey, get out. We really didn't have to lose that money. So let's just say we're absolutely convinced we're going down. We're getting a deeper pullback on our 5-1 chart right to the 165 EMA. So look, let's do the trade one more time. And again, I just want you to see the thought process here. And again, I don't think, if you did the first trade the first time, I don't think you really had to lose. I want you to see, though, the incorporation of the 165 EMA over here. So again, I turned on the system to do a short. And again, same thought process. We're going to get down to support. I want you to look at the small triggers on both of these charts. Again, 10 tick stop, that's just kind of a preset thing. Again, when you have a pivot stop out, traditionally it shouldn't get above that high again, or you're really going to be wrong. So being able to limit risk on a pivot stop out, look at your large chart. You see how we pulled right back to the synthetic, or the 165 EMA? That was the large chart helping a little bit. Again, not a lot. And you saw the first attempt was really, it was a loser. And the market flow warned us 9 times to get out, and I wanted to leave it on for educational purposes so you can see. Now look at the same thought process. Look at the small triggers on my big chart, or my 5-1 chart, I mean. So now the market flow is helping a little bit. The small triggers have rolled over a little bit. Still a very difficult trade. You see how difficult this is? And again, I wanted, we could do all easy trades all day long, but I wanted you to see a more difficult look. And it's not that you can't do the look. You just have to understand, number one, maybe you want to manage it a little quicker at first. And you can see, look, white paint bar to the downside. Put the stop above the white paint bar. I've got a break even in. So, again, a couple things that are a little more helpful now. Not a lot, but the small triggers rolled over on the 5-1 chart. We had divergence on the 5-1 chart. We had a sharp point on the 5-1 chart. And we were able to use the white paint bar from the market flow to essentially get our risk down to zero very quickly. So if we don't go, we've now gotten ourselves to at least a break even. Again, I want you to see, more difficult looks. And, again, as a new user, you don't really want to trade into trouble on the big chart. It can be done, but it's a little more of a difficult trade. And again, once you get to a prior divergence pivot stop out like we have here on the 5-1 chart, get your stop down to break even plus. Using that reversal bar marker on the 5-1 chart to help us out. So if we make an up bar on the 5-1 chart, we're out. Again, look at your market flow. The market flow here is helping a short position now. See the high volume line and the small triggers going down. So again, I've opted to wait for an up bar on the 5-1 chart to get out, which would still be a couple tick winner. But because of the market flow, high volume resistance pushing to the downside for us here, and the triggers going down, I'll say, let's see if we can actually make it to support.
Order filled.
So again, we've taken a difficult trade and we could have managed it better. And then we've taken really a stab back to the 165 EMA on the big chart and, could have done that at any time a little bit easier, but you can see the difference between the two and how to manage those different types of trades. All right, so you can see very, 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 very easy.
Order
super,
pending.
Super strong large chart. Market flow buy signals from mid bands, which was the last spot over here on our smaller chart. And, with this super, super, super strong look on our large chart, this is our highest probability trend trade that we do. The last area on our large chart, white paint bars to the downside with a market flow bar into it, and absolutely everything screaming up on our big chart. Now, white paint bar to the upside on our small chart allowed us to get our stop up, right? So again, looking at the large chart, it's great. Looking at the small chart, it's great. Once we reach a prior divergence high, we get our stop to break even. So again, prior divergence highs, always get that stop up. This one is a very high probability that we're going to go up and we're going to make it to Fibonacci resistance. It's the trade that we live for. I mean, it's everything in our favor. Market flows helping us here to the upside. Everything is perfect and all systems
Order
go for
filled.
just making a ton of money to the upside. And we just got stopped out. So, again, management of trade in this situation was ultra important. And you can see very quickly what happened to us. We got break even or plus a tick, and very quickly our trend changed to the downside. Now, this is almost identical to what we saw before, with the exception of we're now doing a trend trade long on our big chart. And again, I wanted to add this one in here. It's a little bit different. Notice the pattern on our 5-1 chart. This is the type of pattern on our 5-1 chart. 3 bars down, Fib to Fib oscillator, and a reversal bar on our market flow chart. That is the counter trend entry. Now, I know this is a little bit different because you're thinking, should I have done a trend trade short on my little chart? And essentially what I wanted to show you was a trend trade long on the big chart. And I want you to really kind of take a step back and think about your large chart. This is the perfect look for the perfect trend trade. Super strong triggers up, no divergence, super wide synthetic triggers. And we ended up with a pattern long on our smaller chart. And you can see very quickly and very easily that trend trade long on our big chart produced a very, very good winner. So I know you spend a lot of time or all of your time focusing in on trend trades on the small chart. But I threw this one in here so you don't forget about perfect trend trade longs on your big chart. Again, we talked about trading into spots on the big chart and the downfall of what happens. And again, I want you to be able to take advantage of trend trades on the big chart. And look what happened. It went up. We changed our trend. We pulled back to our mid band. So now we went from trend trade long on our big chart, which is our counter trend trade, right into a potential trend trade long on our small chart. So again, look at what we're doing. We're pulling back to, some
order pending
further away areas. So we've got mid bands. We've got mid bands on both charts. We've got perfect little market flow reversal bar to the upside. And we've got a trend trade. This is just a little retracement inside of the trend trade long on our big chart. So again, this is another high probability look for us where, again, we get the bars up on our 5-1 chart, we pull our stop up. We start to get white paint bars to the upside. We start thinking about moving our stops to reversal bar markers. As our reversal bar marker moves up and gets a little bit closer to the bottom of the white paint bar, we again are able to reduce our risk using that white paint bar and our reversal bar markers on our 5-1 chart. And again, as we push up into market flow resistance, see that high volume resistance? Don't really anticipate it to hold because the triggers are screaming to the upside.
Order filled.
So we've got super favorable big chart. We've got super favorable triggers on our range bar chart. Easily made the first profit target just below our prior support or resistance, prior pivot. Now, we have to decide, do we want to stay in this thing and try to hang in there until we get up to resistance, or do we want to get out of our position? Again, if you got out, you take a winner. But again, situational awareness, we at least like to give it an opportunity to make it up to Fibonacci resistance when it's really strong. So as we reach the prior really divergence pivot high, we start pulling up our stop. And you can see,
order filled.
Signal. We hit our stop. So look, hit the close button. There you go. So again, you can see we put our stop, our target, at 47, and we hit it. There was no fill, and we got a sell signal on our market flow bar. So, if you hit a profit target and you don't get a fill, get out quick. Take that money. So again, it was a really nice opportunity to, take that money and, really, really, really looking at the large chart, we have the potential of, maybe even doing one more trend trade long. So we start to think, are we going to get a trend trade long from the first spot, which is 62.30, right here at our mid band. Or are we going to go a little bit lower? And you can see kind of building in a potential pivot stop out, and we're building in mid bands on our smaller chart, and again, just didn't quite get exactly what we're looking for. But again, look at your large chart. We went from trend trade long on the large chart, which was perfect with a pattern on our small chart, to a trend trade long on our small chart, which was absolutely perfect. Then we went into just missing our last trend trade long. And again, when we get to multiple time frame Fibonacci resistance like we have up here at the top, this is the time where we stop doing trend trade longs. Because once we reach multiple time frame fibs and we have divergence potential on our charts, typically the market's going to go and start pushing to the downside again. And again, situational awareness. Our 14-2 chart was perfect for a couple of long opportunities, and it's still strong to the upside. So, again, when we hit that resistance, though, usually the party's over. And again, it's really, really important when to recognize that the party's over and we're no longer going to be doing long trades. It's going to avoid taking any losers coming off of Fibonacci resistance. So now we end up with what? Coming off of resistance, and yes, we're running into some support on our 14-2 chart. So again, we have to make another assessment. Do we want to take a short trade? Right? So again, usually the first time off of resistance, our mid-band is going to cause a bounce to the upside. So again, some of our counter trend traders would try to buy that mid-band area at 23.24, watching for the market to bounce back up and retest resistance. And generally, once it retests resistance, this is the time when we can really take, trend trade shorts, but they're going to be from, resistance areas up at the top. So again, this isn't one that's been trending down. This is more of a retest of a Fibonacci resistance area. And again, you notice the big gap here. So, we have choices. Do we want to turn it on right now, which we did? And do we want to take the trend trade short from the mid-band on the small chart? Or is this look on the 14-2 chart probably going to bounce us up a little bit higher? Again, these are the things that you have to think through when you're thinking about your trade. So again, you recognize the large gap on your 5-1 chart. You recognize the mid-band and the strong triggers up on your 14-2 chart. So again, this is probably not the best turn on yet until we get back up to this area up here. Once we start retesting resistance and we retest divergences and we retest the synthetic triggers and retesting Fibonacci resistance, now this is the time really where we should be turning the strategy on. Unfortunately, it didn't generate a signal for us. Because look at what we're doing.
Order
we're
pending.
Testing resistance on our 14-2 chart with 3 bars up and our small triggers are still going down. That's like really, really good pattern for a short potential from the edges. So again, one of the things that we want to do is not move our stop, because if we moved it above the high, we just got bumped out. So again, we want to just be a little bit more patient, and we've got a really good look now on our large chart. Our small triggers have rolled down. We retested the resistance. We've got a pivot stop out. We've got pretty much everything in our favor. Now that we've made a down bar on our 5-1 chart, we can reduce our risk. So our risk is what? We've got 8 ticks worth of risk total. And again, we'll start looking for opportunities to reduce the risk if and when the market allows. So as we start making our way down to the mid-band, and we have our fib to fib oscillator at 25, and we have divergence potential, and we start to get white paint bars on our range bar chart, those are the times where we start to think about maybe even taking some profit on our first counter trend trade. And then ultimately, where are we going next? Prior divergence lows, prior lows, these are all really good targets. And again, now that we've taken kind of a first profit target along the way, we want to get a little bit stingier with our stops. And again, look, if I move the target way down to support,
order filled,
because we've taken out or reached the equal low, notice what I did. I pulled my stop down really tight. And again, you get back to a prior low, they're going to bounce. I mean, there was a reason they bounced off of it the first time. They're going to bounce off of it the second time. And what that's going to do is it's going to allow you to, if they do bounce, take a second shot at a trend trade short. So, this happens a lot. You get a trade from the top and from the edges, or, their lows, either way. And then you get continuation of the trend. So not only do you get, the trade from the edge, you also will start to get a trend trade from, a retracement inside of that. And you'll be able to take a second chance at it. And again, the market flow gave us a sell signal here, and I didn't do it, just wanted to kind of talk about it. But you can see that, this is really a perfect area for trend trade shorts. And again, if you had opted for holding your trade through a retracement, which we didn't do in this scenario, after that little retracement and a new down bar, you could have pulled your stop down. So again, we've obviously had a lot of trades and a lot of situations. Now, you can see, going back retrospectively on the 14-2 chart that we have, again, let me spread this out. We've come off of resistance with double divergence. The second time the small triggers have rolled over. And you can see what's happened. Obviously, we had a trend trade short. We had a second opportunity at a short. And essentially, we've made it all the way down to target areas. Once we reach Fibonacci support, again, this is where trend trades end unless we break through support. So again, if you were doing one short or two shorts to get down to support ends your trend trades. And, if we break through, which you can see here, this is a really good look for having broken multiple time frame fibs. So we end up with really the perfect scenario. We've got, multiple time frame resistance on our smaller chart. We've got super strong small triggers down on our 14-2 chart. We've got our synthetic triggers down on our 14-2 chart. And we've broken all of the support. So again, we're looking for short trades. We want to have a trend trade short. Now, the one thing that you're going to, the new user will make the mistake is they're going to go too early. They're going to fail to recognize that our small triggers are above the synthetic triggers. So they're going to be short right now, and they're going to be going, man, why is it not going down? So remember, if our small triggers are above the 14-2 synthetic triggers, start at the 14-2 reversal bar marker, and then say, where is the area that makes more sense? And you can see up here, mid-band on the 5-1 chart, also giving us a little bit of a deeper pullback over here on the 14-2 chart. Again, waiting for the right spot when your small triggers are above your synthetic triggers is very, very important. It's better to miss a trade than to get in at the wrong spot and take a loser. So again, just, this is another just visual representation of strong small triggers above our synthetic triggers. However, super favorable look on our large chart. I mean, we pay money for this, right? So because we came off of fibs, because we had divergence, because our small triggers are screaming to the downside, we're going to have a high probability short. And again, if you go short at the resistance, you're going to get bumped out. If you go short at the mid band, which is not the last area on the 5-1 chart, you can see the white paint bar down here and the small triggers going up. Traditionally, you're going to get an arrow up, then we're going to make it up to the right spot. And then once we actually make it up closer to the right spot, then we end up with the trend trade that fits the rules. So again, it's ultra, ultra, ultra tempting to try to go short at the mid-band on the 5-1 chart. However, the trigger lines, the small trigger lines on both of our range and 5-1 chart tell us we're going higher. And then when we actually go up to the right spot and much closer to the last spot, now we actually turn on the strategy. So essentially what we've done is we've eliminated 2 or 3 losses because of our simple rules of waiting for the small triggers to be, when they're above, we're going to wait for the last areas. So again, we got 3 things working for us here. Number 1, we've reached the last area, which is perfect, closer to the reversal bar marker. Number 2, we have, the dream situation of both of our triggers down strong, coming off of resistance on the 14-2 chart. So now that we've satisfied really the best of the best, all we need is a down bar. And again, the closer we get to that 14-2 reversal bar marker, the better. So again, this is about the spot. And again, I want you to look at your 5-1, fib to fib oscillator here. You can see the 1 bar up into the 100. So if we go down from here, we're going to have a sharp point on the 5-1 fib to fib oscillator, the 5 range fib to fib oscillator, from the right spot with a perfect condition on our 14-2 chart.
Order pending.
And that's really the best of the best. One of 2 things is going to happen. They're going to totally change the trend, and then we're going to have to rethink things. Or, we should get at least back to the synthetic triggers on the 5-1 chart first. And then we have to start thinking about targets on where we're going on the 14-2 chart. So, again, working on your targets first is always a good thing. So, again, let's just move some targets around real quick before, so look, there's a yellow 1-to-1. That's a support area over here on our large chart. So we'll put our target above it. Our stop's in place, so we don't have to worry about anything at the moment. And then now let's take a look at our 5-1 chart. And let's talk about where we're going to put our stop. We're going to put our stop at 16, 15, somewhere right here above this 14-2 reversal bar marker. So again, you can see market flow bars are really favorable. We have an antenna bar to the downside. The next bar has magenta dots in it. We're coming from the right spot. We're coming with the perfect condition. And essentially, we're just waiting for a little more push down here, and then we'll be able to really reduce our risk quite a bit. And again, we don't want to do it too early because, sometimes they come back and they mess around a little bit before going down. If you start a trade out with perfect conditions and perfect reasons, unless the reasons really change, be still willing to risk that $100. And you'll see a lot of times they'll come back and just test the high volume area over here on the 5 range chart. just kind of where they started from. Some people in perfect trades like to add on and kind of double down at those types of spots, but we're not going to get into that today. So again, all we're doing is simple. Oh, look, white paint bar down. So we've got two things. We've got a down bar on our 5-1 chart, which is great. And we've got a white paint bar to the downside. And again, this is a situation where you don't want to mess around too much, right? Because this area right here, market flow-wise, should hold the market down and keep it going down. So we want it to actually go down first before we start reducing risk. So as we get back to support at 6,200, you can see we've used the 5-1 reversal bar marker. So we've only got a couple ticks of risk. So if this thing goes down, we've got, hundreds of dollars of potential for only $20 worth of risk. And again, because of the overwhelming look and the super high probability look on our 14-2 chart, we don't want to mess around too much and give them any reason to come get us. We want to allow the market to work itself out and start working its way down to target areas. And again, you can see we got back to our first, prior synthetic triggers, which is always a really good spot to take a first profit target if you want to. And again, once you get 20 ticks in a trade, anytime you can get 20 ticks out of a trade, which is half of our daily goal, that's a really good
order filled.
Really, really good target. And you can see pretty easy here. Obviously, I moved it up, but this thing didn't even blink. If we waited all the way for 75, very, very easy trade. Obviously, they really started to kill this thing here. So anyway, trading from the edges, allowing that perfect look on the 14-2 chart to kind of marinate. And, that's that high probability look that usually gets us to our targets.